Good day, this is Steve Meldrum from Swell Private Wealth, and we're going to do our first dental webinar with you today and run through a few different items to get you thinking about how you don't have to lose a penny during any crisis. So first off, I wanted to start with this cartoon. I think it really sets the stage to think of things in a different manner. So I'll give you a few seconds to review that. You would have noticed that the way in which the two parties were battling changed. And I want you to be thinking of some of what we shared today. Maybe you've heard of it before, but maybe you haven't actually given it a really deep look. So myself personally, I've done different speaking events for most of the dental conferences out there, PDC, Northwest, SOHP, and so on and so forth. So this is just a list. We spend a lot of time in this sandbox, and we like it. It's fun. I've got a couple brother-in-laws that are dentists and one that's a specialist. So we have lots of conversations from many different levels. In all of this, we figured out what dentists want. It seems that they always come up with the same types of questions and concerns, and this is what we know. First, they want to save taxes now. They want to save taxes in the future. And they want to be able to transfer their wealth to either their kids or the causes that they care about. Let's start by talking about taxes now. It's important to understand that when a dentist earns income, they earn it in two ways. It can be active income or passive income. Active income underneath 500,000, or the small business deduction, is taxed in Alberta at about 11%. Okay, when you earn over $500,000, then that next dollar is taxed at 25%. However, once you've earned your money into your practice, and if you keep it inside the corporation, then it can potentially pay an even higher rate of tax. And this is called passive income, or income and interest that's earned on top of your assets. So that tax rate is 48.67 here in Alberta. So quite hefty. And the challenge is a lot of people don't want to pay that rate of tax. So they end up crossing what we call the tax bridge, and they cross the tax bridge into their personal income. But the challenge is the higher the income, the higher the tax rate. And again, in Alberta, it gets to 48% tax at the highest rate. So you're in a struggle here that if you keep your money inside the corporation, you'll be paying potentially high rate tax. And if you move it, you'll also be paying high rate tax. This is a newer concern since 2019. This next slide, what we call AAII. This stands for Adjusted Aggregate Investment Income. You can talk to your accountant about it, but essentially it says that if you earn over $50,000 of passive income, that's income that you've earned on an asset that you have had in place, then you're going to start reducing the amount of the small business tax rate that you can have. So again, small business tax rate is 11% up to 500,000 a year. So in this case, if you earned $75,000 of passive income, AAI income, then you would only be able to get low rate tax up to approximately $400,000. Every $1 over 50,000, you lose $5 of small business rate. So this is how it works now in 2020. Next is how they transfer their wealth. Specifically, we know that if you transfer assets from your corporation to yourself personally, there's going to be a tax consequence. So if you've left it in the corporation, then you pass away or die, assuming you don't have a spouse to pass things tax efficiently to, then you might pay double or even triple tax. Some of those tax consequences come from, first, the capital gain of the investment that you have. Second, the capital gain on the shares of your corporation. And third, any dividend tax or deemed disposition when it crosses over to you personally, being the estate. So how we're going to solve a lot of this is through life insurance. And we want you to think of it as an asset. And there's a few reasons why. So I'm going to give you a moment to read through this section of the Tax Act. Okay, so this is quite critical because now I'm going to show you about what dentists want, which is to save taxes now, save taxes in the future, and transfer wealth to their children or causes that they care about, how life insurance can accomplish this. First, I have to give you some understanding of life insurance and the couple main types. First, if we compare it to real estate, is the type of insurance that you rent. So renting insurance is the gray stepped line. And the gray step line is trying to keep pace with the mortality, meaning, you know, the older you get, the more expensive it is to pay for it. You'll see this blue line, which is representing owning your insurance. And owning your insurance starts out more expensive, but the benefit is you know that you're building equity, and that equity will be there for you when mortality costs are greater, okay? And specific to what we're sharing today, the insurance company will be the one that manages that investment so that we can have stable, predictable returns. Just like real estate, you can pay for your home very quickly. So in this case, we showed how you can compress and put a lot of money in at a time. Everything we show you today is scalable, meaning you can, present it with in a small manner or a very large manner, and it's sky's the limit on how you can apply it. So again, the blue section is where you've been able to put excess money into an insurance policy. That excess money is able to grow tax sheltered. So with knowing some basics of insurance, let's talk about how we're going to save taxes now. Quite simply, insurance is still insurance. You do pay premiums on it. And if you paid $1,000 a year for a premium, whether you paid for that corporately or personally, we need to factor in the tax of that. So if I paid for $1,000 a year personally, it really would have cost me roughly $1,900 by the time my corporation earned it, it paid tax, it crossed the tax bridge, and then I paid tax personally. So it's quite expensive to pay for your life insurance personally. Or I could have my corporation pay. And if my corporation pays, it's just over $1,100 a year to cover that $1,000 premium. So we can see that there's quite a bit of savings by having the corporation pay for the insurance rather than personally. Saving taxes in the future. If you recall the chart that I had saying that if you earn over $50,000 of AAII income, which can be income from capital gain on investments, it can be from rental property or other interest income. Again, talk to your accountant. But if I put money inside an insurance policy, it does not factor into AAII calculations. And that's really critical because then we're able to maintain our small business rate, which is 11% in Alberta, versus hitting a tax rate of 25% by having our small business rate ground down with too much AAI income. So we can save quite a bit of taxes in the future. Now, we've talked a little bit, I want to go into a side note, because if we're putting money inside the insurance policy, we want to understand how it earns money and how it's going to grow. First off, I want you to see from this Venn diagram that there is investment returns. That insurance company, they're able to go and invest for very long durations. They can invest, buy something and hold it for 30, 40 years, and they're fine to do that. So they're going to be able to get investment returns, but they also get value from other aspects. First, mortality gains. This is if they assume someone, statistically people will die at a certain point, but they don't, and they have a better experience, they're able to pass on those savings to you, the policyholder. Also, when people do purchase insurance policies, a certain percentage, a small percentage, do cancel their policies. But remember, with owning your insurance, you're overpaying initially. And so if someone goes and overpays for a number of years and then cancels early without dying, they're essentially giving up a lot of benefit. And that benefit goes back to the remaining policyholders. And of course, lastly, expenses. So with the advances of technology and so forth, there's able to be increased savings. Those savings are passed to you as the policyholder. So all of these aspects form dividends, and with dividends, it increases the value and the equity of your insurance policy. The value being upon death, and the value being equity if you needed access to that money again. Now, the last thing dentists want is to know how to transfer their money to their kids or causes. And if we show with this diagram putting money into an insurance policy, we can create it so that the cost is low and the ability to put in excess money is larger. Then if that's grown there tax sheltered for a number of years and a person does pass away, they're able to have the bulk of that, if not all, transfer underneath the tax bridge through an account called the Capital Dividend Account, or CDA. You can ask your accountant about this, but CDA is only created by two things. First, life insurance proceeds, and that's the death benefit minus adjusted cost basis. And second is the non-taxable portion of a capital gain. So if a corporation earned a capital gain, then half of it is taxable and half of it can go underneath the tax line through the CDA, or Capital Dividend Account. So there's only two mechanisms, but the beauty is if you've sheltered your money inside an insurance policy, and when you have it in this particular type we have, it's unable to go negative. So you can never have a negative year, which is great during the crisis. Then upon death, the entire amount can transfer underneath through the Capital Dividend Account. Now, as a summary, we talked about when the corporation or the PC earns money, they can pay a small business rate, or they can pay a passive tax rate. Small business being 11%, or passive quite high, almost 50% tax. So a lot of people say, well, how else can I use this insurance policy? I don't want to die to get the benefits. And I agree, that's not a good proposition. So I want to point out a few more items. First, whenever you see opportunity, you can pursue that opportunity, whether it's in business or it's in the market, because this asset remains positive. It cannot have a negative year. It cannot go down in value. Because of that, when other items do go on sale, you can access this cash in numerous ways and deploy it to the new venture, the business, or other items that you wish. Next, if you became totally disabled, you can receive the equity tax-free out of the policy. And that's a special provision by the Canada Revenue Agency, but it's important to know that there is a way to access that money without creating a tax consequence. We are going to have 2 more webinars, the next both on April 21st and April 28th. April 28th, we're going to be speaking about retirement. So if I've accumulated all of this money inside my insurance policy, there's 2 main ways to access that money. My corporation can access it, or myself as a shareholder can also access that money. And so there's some very tax efficient yet particular structures that we would want to educate you about. So hopefully we can see you on the next April 28th webinar. Coming up though, next week we're going to be speaking about tax deductions that you can gain from your insurance policy. So you heard me right. You can use your insurance policy to create tax deductions and still have opportunity in the market or in your business. So we're going to be speaking about all of those benefits with insurance policies. Again, here are the webinar dates and times. You're able to reach out to me via email, social media, also our Calendly scheduler. Any of these sources, I'll be happy to assist you where you would like. We'll leave it for a few moments. And just to close, I want to say thank you for taking your time and investing in yourself and investing in your knowledge, because I truly know and believe that there's great opportunity out there at any point in time. You do not have to lose money during a crisis. In fact, you can capitalize on crisis and you can continue your growth and continue building your practice. Thank you for your time. I'm Steve Meldrum from Swell Private Wealth.